Picture this. You just survived a long month working fast food. Grease burns, angry customers, the whole deal. Payday hits. Your job says you earned $2,000. You open your bank app and only see $1,456. So what happened? Taxes happened. Taxes are money you're required to pay to the government. They use it to build roads, run schools, pay firefighters, inspect restaurants, and yes, fund things you'll probably never see. There are different types of taxes. Income tax, taken from the money you earn. Sales tax, added when you buy stuff. Capital gains tax, taken from profits you make from investing. Social Security tax, money set aside for you when you're old. Medicare tax, helps pay for healthcare, mostly for older people. Social Security is basically the government forcing you to save for retirement. Medicare helps cover medical costs for people who need it. Filing taxes is the weird part. The government already knows how much you owe, but makes you figure it out anyway. If you're right, great. If you're wrong, not great. Taxes are annoying, but countries that collect taxes, well, usually have better schools, healthcare, and overall quality of life. When you put money in a bank, it feels like it's sitting safely in a vault somewhere. In reality, it's not. Banks don't just store money, they use it. If you deposit $1,000, the bank might keep $100 and loan out the rest to someone buying a car, starting a business, or, yes, buying a jet ski. This system is called fractional reserve banking. Banks make money by paying you a small amount of interest, charging borrowers more interest. Why use a bank? It's safer than hiding cash in your room. It's easier to pay with cards and apps. You earn interest. In the US, deposits are insured up to $250,000. Banks aren't dragons guarding gold. They're middlemen moving money around. Interest is the cost of borrowing money, or the reward for saving it. Borrow $1,000 and pay back $1,280? That extra $280 is interest. There are two types. Simple interest is calculated only on the original amount of money, the principal. Example, you invest $1,000 at 5% simple interest for 5 years. Total after 5 years, $1,000 plus $250 equals $1,250. The interest stays the same every year. Compound interest is calculated on the original money plus all the interest already earned. This means your money earns interest on interest. Example, you invest $1,000 at 5% compound interest for 5 years. Total after 5 years, $1,276.28. Each year, the interest grows because the base keeps getting bigger. Compound interest can work against you like credit cards or for you like investing. Miss a credit card payment and suddenly your $12 snack turns into a $50 mistake. Invest money early, and over time, it quietly multiplies. Rule of thumb: if you're paying interest, eliminate it fast. If you're earning interest, give it time. Interest is either your enemy or your employee. Ever notice snacks getting smaller and more expensive? That's inflation. Inflation means money slowly loses buying power over time. Your $5 bill still says $5, but it buys less than it used to. Inflation happens when too much money is chasing the same products. Costs to make things go up. People expect prices to rise and rush to buy. A little inflation, around 2% a year, is normal. Too much hurts savings and paychecks. To slow inflation, governments raise interest rates, which makes borrowing more expensive and spending slower. A recession is when the economy shrinks for about 6 months or more. Jobs get cut. Businesses slow down. People spend less. Recessions happen for many reasons. High interest rates, global problems, natural economic cycles. Think of the economy like a party. At first it's fun. Then the music stops, the lights come on, and everyone suddenly remembers rent exists. Recessions don't last forever. They're painful resets. A credit score is a number that shows how trustworthy you are with borrowed money. It ranges from 300 to 850. Below 580, risky. Above 750, very reliable. It's based on paying bills on time, how much credit you use, how long you've had credit, types of credit, how often you apply for new credit. Your credit score isn't about how rich you are. It's about how reliable you look. You can have no debt and still have a bad score if you've never used credit. Treat your credit score like a pet. Ignore it and it causes problems. Money isn't real in the way rocks or trees are real. It works because we all agree it works. A dollar has value because people believe it does. Same idea applies to digital money, cards, and apps. Governments control money supply, so there isn't too much. Inflation. There isn't too little. People can't afford basics. Money is built on trust. Investing is how you protect your money from inflation and grow it over time. Instead of trading time for money, you let money work for you. Common investments. Stocks, small pieces of companies. Bonds, loans you give to governments or companies. Funds, groups of investments bundled together. Real estate, property people pay to use. Investing isn't about luck. It's about starting early, spreading risk, being patient. The biggest risk isn't losing money. It's never investing at all. Money flows to value. A rock is just a rock. Unless it's rare, shiny, and people want it. Then it's valuable. People earn more money when they create more value. Doctors save lives. Engineers build systems. Businesses solve problems. Brands charge more because people believe they're worth more. If you can create value or convince people you do, you can earn money. Time is the most valuable asset you have. Most jobs trade time for money. Work an hour, get paid an hour. The highest earners figure out how to use skills, use systems. Let money and time multiply. Time matters most in investing. Small amounts, invested early, can grow into big money over decades. Wealth isn't built fast. It's built slowly, consistently, and patiently. People who retire rich didn't cheat the system. They understood it and used it.